Recently, some people in China shared that Vietnam has started to crack down hard on Chinese-funded businesses exporting goods.
突发，越南出狠招，中国货被重点盯防。
Breaking news. Vietnam takes tough measures as multiple departments launch joint actions. Chinese goods are under strict surveillance with thorough inspections of Chinese raw materials. The origins of factory products are all being checked, and even labels indicating Vietnamese manufacturing are now subject to strict scrutiny.
The reason for this is that China has been routing exports through Vietnam to avoid U.S. tariffs, but now, under pressure from the U.S., Vietnam has started blocking this kind of trade. This means the route that China used to take, exporting through Vietnam to get to the U.S., has basically been shut down.
但是最近看到了很多来越南创业的中国人。
Recently, I've seen many Chinese people coming to Vietnam to start businesses, but most have left disappointed. That's because the products here are already very abundant. Think about it. The market is only so big. Why would you be able to grab a share just by coming here? If you had come 8 years ago, you might have had a real chance, but now it's 2025. My advice is don't come.
For years, China had been setting up transshipment hubs in Southeast Asia, but the U.S.'s reciprocal tariffs policy has now wrecked those efforts. Vietnam, which had taken on a large share of industries shifting out of China under the China Plus One strategy, has taken the biggest hit. Many Chinese Vietnamese business owners are complaining that it's getting harder to do business in Vietnam, especially for those who just came this year to open factories. Some say they feel hopeless. According to a report on May 17th, several Chinese investors in Vietnam said their factory plans have been put on hold. A business consultant named Mr. Wang said he worked hard to secure contracts for several Chinese electronics and toy companies to open operations in Vietnam. One project was worth up to $100 million, and one client had even paid a deposit. But the harsh tariff stopped everything in its tracks. Mr. Wang runs a consulting firm in Hanoi that helps Chinese companies expand into Vietnam. He sighed and said, "We thought the worst-case scenario was a 15% tariff, but it turned out to be way higher. All the factory contracts have hit the brakes. Everything is basically frozen. Setting up a factory involves big investment. Once the money is in, you can't pull out. No one wants to take that kind of risk right now." Mr. Guo, who has been in Vietnam's textile industry for many years, is also worried. He had brought his business partners from mainland China to Ho Chi Minh City to look into building a yarn factory. But once the tariffs hit, the partners quickly dropped out. Another one of his friends had planned to build an 80,000 square meter factory. Even though 60,000 square meters had already been finished, they decided to pause the rest of the work. Things aren't looking good for Chinese restaurant owners in Vietnam either. One Chinese restaurant that had just opened recently already went bankrupt. In the comments online, some people said that Chinese restaurants in Vietnam are way too expensive and mainly try to rip off fellow Chinese customers. Ironically, Chinese business owners in Vietnam, especially those relying on Chinese raw materials and doing re-export trade, are the ones taking the hardest hit. Meanwhile, Vietnam's local businesses are thriving. Vietnam's economy depends heavily on exports, and the U.S. is its largest market. Facing high tariffs, Vietnam quickly entered negotiations with the U.S. Like many other countries and regions, Vietnam was granted a 90-day suspension of the reciprocal tariffs on April 9th. The tariff rate on goods exported to the U.S. was lowered to 10%. This short grace period gave factories some breathing room, and they rushed to ramp up production. Some Vietnamese companies said they were overwhelmed with orders. One business said they received a full year's worth of orders in just 1 month. Another said they didn't have the capacity to handle any more work. A woman who works in foreign trade said,
不要再去跑越南了，越南的工厂已经冒烟了。
"Stop heading to Vietnam. The factories here are already running at full steam. I just finished working with clients who returned from a trade show in Vietnam. Based on their feedback, the local factories, especially those making fast-moving consumer goods and outdoor products, are overloaded. For those developing new export markets, it's better to look elsewhere for now." Some people online said that back when Trump first took office a few months ago, there were already warning signs not to move orders to Vietnam or invest there. The factories were already too busy.
过去啊，国内的工厂锅都揭不开了。
Factories in China are struggling to stay open, but in Vietnam and Cambodia, machines are running so hard they're practically smoking. There's no spare capacity left. China's supply chains are breaking, and global orders are shifting. This isn't just a trade war anymore. It's a battle over production capacity.
Huang Qizhao, vice chairman of Vietnam's Global Electronics Trade Association, said that when the U.S. first raised tariffs, shipping volume at Haiphong port in Vietnam dropped by 30%. But after the tariff hike was paused, shipments quickly jumped by nearly 20%. Some clients are now sending hundreds of containers at a time to the U.S., showing strong demand from American buyers. Back in 2018, when President Trump launched the first round of the U.S.-China trade war, many Chinese companies began relocating to Vietnam to avoid tariffs. The China Plus One strategy is when companies set up another base outside of China to spread the risk. This made Vietnam a top alternative. In 2019, Vietnam approved 705 new projects from Chinese companies, totaling nearly $2.4 billion, up 96.5% from the previous year. Chinese investment in Vietnam has continued to grow ever since, covering industries like textiles, manufacturing equipment, electronics, and energy. This year, car makers like Chery and Geely have also entered the Vietnamese market. Foreign investment into Vietnam grew by 1/3 in 2023, most of it going into manufacturing. Apple, Intel, and Samsung suppliers all have factories in Vietnam now. Meta, the company behind Facebook, is also looking to expand its presence there. More and more multinational companies are now adopting the China Plus One strategy. This shift is also driving up real estate prices in countries near China, creating a sharp contrast with China's sluggish housing market. According to real estate firm JLL, in the first quarter of 2024, total leased space in Asia was 5% higher than the 5-year average. India recorded its second highest quarterly leasing volume ever. Knight Frank reported that in the first quarter, home prices in Ho Chi Minh City rose by 6.6% compared to the same period last year, making it one of the fastest-growing cities in Asia in terms of housing prices. In contrast, the real estate situation in China looks much gloomier. According to forecasts by CBRE Group, rental prices in China's largest cities are expected to drop by 6% in 2024. Christine Lee, head of research for Knight Frank Asia Pacific, said rents in Vietnam are rising much faster than in other countries. She explained that demand is clearly shifting from China to other parts of Southeast Asia and India. While many new office buildings are being completed in China, demand is falling sharply. During the pandemic, office construction in China was delayed, and now, even though supply is rising, demand has not kept up. By the end of fourth quarter 2023, vacancy rates for premium office buildings in Shanghai and Shenzhen had risen above 20%. In second-tier cities like Hangzhou and Wuhan, the recovery in leasing has been slow, and vacancy rates continue to climb. In Wuhan, vacancy in top-tier office buildings has already reached 33%. Knight Frank predicts that in Shenzhen, a southern tech hub, 1 in 4 high-quality office buildings will sit empty. With even more new buildings being completed in 2024, available space is expected to increase by another 23%. Meanwhile, S&P Global reported that property sales in China are still falling. Structural issues are putting pressure on related developers, and the real estate market continues to search for a bottom. While China's property sector is struggling to attract investment, foreign investors are shifting their attention to countries benefiting from China's industrial outflow. So why are Chinese companies now losing in this competition over manufacturing capacity? Experts say that during the China-US trade war, many Chinese companies moved their factories overseas to avoid high tariffs and tried to maintain exports through re-exporting. In the early stages, this wave of investment helped boost manufacturing in countries like Vietnam. With its land connection to China and similar socialist system, became one of the biggest beneficiaries of China's capacity shift. Its export figure surged, and industrial land became extremely scarce. But as the global supply chain restructuring deepened, Chinese companies began to fall behind their Western competitors. The reasons go beyond market conditions. They also involve the deeply rooted management culture of Chinese firms. One major problem is the pollute first, clean up later approach. In China, this trade-off between pollution and rapid growth has long been accepted. Many Chinese companies brought this exact model to Southeast Asia. In Vietnam, some factories built by Chinese investors were found dumping untreated wastewater and releasing toxic gases. Others broke local laws, skipped environmental assessments, or built illegally. These actions sparked public anger and damaged the image of Chinese companies. In many areas of Vietnam, protests broke out over environmental issues linked to Chinese firms. Local governments responded with tougher enforcement, which drove up operating costs and shook investor confidence. Another issue is labor rights. Chinese companies are known for long hours, low pay, and harsh management styles. When this model is exported, it clashes with labor expectations in countries like Vietnam and Cambodia. There have been frequent reports of forced overtime, wage deductions, and even crackdowns on labor unions in Chinese-run factories. In 2020, a Chinese-owned electronics factory in northern Vietnam faced a large worker strike. Thousands of workers protested low wages and harsh treatment, chanting that they'd rather work for Korean companies. By March 2025, multiple large-scale strikes broke out again. In just 1 week, 10 Chinese-invested companies faced collective action from workers, protesting what they called extreme exploitation. These events show that the so-called low-cost advantage of Chinese companies often comes at the expense of labor rights and human dignity. Once that tolerance wears thin, backlash follows. Another issue lies in how Chinese businesses often operate. Many still rely on personal connections and gray areas, practices that might work in China but clash with the systems in countries like Vietnam and Indonesia. Reports have exposed cases where Chinese firms obtained land through shady deals, bribed officials, or evaded taxes. These violations damage fair competition and draw intense public criticism. In response, local governments have increased their scrutiny. Even when production moves to Vietnam, many Chinese businesses still depend heavily on raw materials, machinery, and engineers from China. The US and other countries are watching this closely and are treating these goods as essentially still made in China. As a result, some products still face tariffs and tech restrictions. This shows that Chinese firms haven't truly separated themselves from the Chinese system, and they continue to face high risks. At the same time, countries like Vietnam and India are seeing rapid growth in property prices and industrial land rents. In Vietnam, for example, land prices in key industrial zones have doubled in just a few years. Living costs and worker wages are also rising. For Chinese companies that had hoped to cut costs by changing the country of origin, this shift has become a financial burden instead. Back in China, things aren't looking much better. The property market continues to decline, and both companies and individuals are losing asset value. At the same time, banks are tightening their lending policies. This makes it harder for Chinese companies to finance overseas expansion. With rising costs abroad and shrinking capital at home, many firms are now stuck. Staying in China means facing high tariffs and rejection from foreign markets, but moving overseas means facing higher costs and stricter regulations. Either way, it's tough to move forward. By contrast, Western companies realized earlier on that reshaping supply chains isn't just about relocating, it's also about improving corporate governance and accountability. Companies like Samsung and Apple have made major investments in India and Vietnam. In choosing suppliers, they emphasize environmental standards, labor rights, and transparency. Their goal is to build a sustainable, stable local supply network. One person online said that Chinese companies in Vietnam are losing to their Western competitors because of their own behavior. They can no longer rely on re-exporting to survive, and when it comes to competing in Vietnam's domestic market, they're losing badly. He pointed to Chinese motorcycle companies trying to enter Vietnam as the perfect example, a reflection of why these firms are failing.
20年前的越南街头，每10辆摩托车里
20 years ago on the streets of Vietnam, 8 out of every 10 motorcycles were Chinese brands. But in less than 5 years, Chinese motorcycles suffered a major collapse in the Vietnamese market. When Chinese companies like Li Fun and Longxing first entered Vietnam, they used aggressive low pricing to disrupt the market. A 100cc motorcycle dropped from $1,200 to just $270, less than half the price of Japanese models. Japanese brands were caught off guard and quickly lost ground. But within just 5 years, Chinese brands went from holding 80 to 90% of the market down to less than 10%. Japanese companies like Honda and Yamaha reclaimed 90% of the market. This dramatic reversal holds a key lesson for Chinese companies going global. After undercutting Japanese brands, Chinese motorcycles briefly dominated the market. That success attracted many other Chinese brands to Vietnam. In just 2 years, nearly 50 Chinese motorcycle companies flooded into the country. Once there, the companies started competing against each other in a brutal price war. Prices dropped month after month. Wholesale prices even fell below production costs, down to under $200. In the case of Li Fun, each motorcycle sold in Vietnam made them only about 30 to 50 yuan, which was basically charity.
The worst part came when companies cut corners just to stay afloat. The steel used in the frames was reduced from 1.2 centimeters to 0.8 centimeters, weakening the structure by over 30%. Steps like electrophoresis and coating were skipped, reducing the rust protection lifespan from 5 years to just 1. Vietnam's terrain is mountainous, so motorcycles need to be durable. But Chinese bikes started breaking down in just 8 months. Their engines needed major repairs 6 times more often than Japanese bikes. Many owners found found themselves constantly repairing their motorcycles or stuck on their way to the repair shop. Because of these quality issues, Chinese motorcycles lost their original reputation for being affordable and turned into a symbol of poor quality. In a 2005 media survey in Vietnam, awareness of Chinese motorcycle brands was as high as 92%, but only about 30% of people had a positive view of them. The endless price wars eventually pushed the Vietnamese government to step in. Although the low prices had knocked Japanese brands out of the way, they also put Vietnam's domestic industry at risk. In 2002, the Vietnamese government introduced import quotas and doubled tariffs. They also pushed for more local production. Most importantly, the government stopped issuing permits for new foreign factories, cutting off Chinese companies' ability to operate legally. At that point, Chinese companies realized they weren't ready. 70% of their parts were imported, and when tariffs jumped from 15% to 45%, their costs skyrocketed. Meanwhile, Japanese companies had already prepared years earlier. Honda, for example, built 6 factories in Vietnam and localized 95% of its parts production. While Chinese companies struggled to survive, Japanese brands moved quickly to regain lost ground. With almost no profit margins, Chinese brands had little to invest in research or innovation, and their technology stopped advancing. In 2003, the Vietnamese government tightened its policy completely. If Chinese companies didn't localize production, they would be banned from selling in the country. Chinese firms were forced to either pull out or sell their factories at low prices to Japanese companies. By 2018, Chinese motorcycles held only about 1% of the market in Vietnam. The once glorious success had crumbled into nothing. At the heart of this collapse was short-sighted business strategy. Chinese companies focused only on gaining market share, while ignoring sustainable profits, investment in technology, supply chain development, and policy risks.
Business is like warfare, but true success is never achieved through simply crushing competitors with low prices. The downfall of Chinese motorcycle brands in Vietnam proves that low prices without quality are like building a house on sand. One strong gust and it all comes crashing down. Using low prices as a cutthroat tactic ends up destroying the company itself. Low pricing can't bring in enough profit, can't support fair labor conditions, can't fund research or innovation, and can't maintain product quality or brand value. Eventually, companies that rely on this strategy will be eliminated by even fiercer competitors. Only by focusing on quality and earning reasonable profits can firms build a more stable path to global success.
Experts believe that the failure of Chinese companies' re-export strategies in Southeast Asia isn't because of the rise of other countries, but because Chinese business culture has failed to adapt beyond its own borders. Long-standing issues like environmental damage, labor exploitation, ignoring local laws, and relying on backroom deals have become major obstacles in today's global value chain, which demands responsibility and sustainability. Unless Chinese companies overhaul their rough, short-term business practices, relying on re-export strategies alone won't be enough to maintain their global manufacturing role. In the future, only those who grow by following the rules and respecting the shared values will earn a real place in the new supply chain.